Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Revision Network. Today we're going to go through the EIA numbers in our normal fashion in terms of overview, refined products, and looking at exports. And we're going to try to put some color around what's happened with the hurricane, what is the residual, how is COVID impacting refining demand, refined products demand, pricing, and then wrapping up with exports. And what do we expect happening over the next coming, at least the next 3 months when we start looking at new flows coming online. So before we get into the overview, we just like to remind you, please like, share, and subscribe. We like to think we're providing some good content that's data driven. So please support us, and we can keep this free. So now just kind of jumping right into some of the impacts. So I thought this was a really good chart that was put out by Bloomberg that really highlighted the issues that we've seen from now what has become the fourth hurricane with Zeta hitting the Gulf of Mexico. Just to give you an idea, there's about 200,000 barrels a day of production still offline due to the Hurricane Zeta, but that should pretty much clear itself out by the end of this week, and they should be fully back and operational. But it's just interesting to see that the storms have cut about 35 million barrels of Gulf of Mexico production since mid-August. So just to put into account that 35 million barrels has been taken out of the market, which is, if we start to look at the different numbers when we're considering storage, obviously this is 35 million barrels that isn't in storage because it was drawn down. Now, given there was also the other side, we had refiners that came down. So it's not a clear one-to-one, but it is important to appreciate that the storms did have a very big impact when we start looking at what is going to happen over the next few months as we get past hurricane season and as we start to see some stabilizing moves, not only onshore, but also offshore as we head into the winter months. So now when we just look at the crude stock draw, it was a relatively large draw. Obviously, it was 8 million barrels in commercial. And then once we factor in the Strategic Petroleum Reserve, or the SPR, there was another 150,000 that came out. So the total draw was 8.15 million barrels. The interesting aspect is obviously Pad 3 was the biggest hit as we had the hurricane, shutting down production, shutting down exports, shutting down imports. So obviously there was that aspect that was coming through. But Pad 2, when we look at Cushing, it continues to build. We had a small draw last week of about 400,000. Now we have a build of about 940,000. And it's just important to appreciate where things sit as we go into a slower period over the course of November. And the reason why November could be slow is just because the heating degree days is going down. So it is just going to be, there's going to be some additional pressure. Now, the other problem is that we're getting to the end of the harvest season. So we'll start to see a little bit less demand within Pad 2. Cushing is one that is going to struggle just because when we start looking at spreads, you have to consider what is going to happen going forward. And this will go in greater detail when we get to the export section. But as we look at spreads continue to remain relatively tight, which is going to keep flow going from either Cushing into Magellan or LLS and into the rest of the market. And this is something that we're going to have to see some of these prices start to loosen up in order to get some of this flow back into the water. And obviously, this is looking further out into the end of November, December, January, when you'd be buying now to take delivery at a later period. And when we look at production, this registered a decline of about 600,000 barrels a day. The peak that we had, which we reported in the Econ show, then again in the Frac Spread show, was we got to about 1.3 million barrels a day offline, which is you can pick up in the Zeta comment. First slide, it got to about a peak of about 1.7, but again, that was kind of short term, and then we quickly saw that turn around, and we averaged about 1.3 over the course of the most of those days. But we started to return as we got through Thursday, Friday, which is why it's only down by 600. Now, getting into the total, clearly we had another nice little draw coming out of this is the inventory looking at SPR as well. The SPR draws will start to slow as they have continued to slow, but there's still some in there. So we'll keep watching that as long as it's applicable to what's currently happening on total storage. This is Cushing. Cushing, you can see that the trend remains up. We had a little bit of that drop, but again, the slope clearly isn't as steep as it was before, but the trend is still to the upside. And as we start to get into as we start to head into November, the question is going to be, can we get some of this drawdowns, either into the coast, or will we start to see some slowdowns in U.S. onshore production? Which, based on what the frac spread is saying, the answer is no. And we're going to continue to see companies trying to offset some of these decline curves and keep this production relatively flat as we head into 2021. And that's when we start to turn to commercial. Now, this is excluding the SPR. We're still at all-time highs on that seasonal adjusted level, but again, you can see that we're getting closer to the top of the cloud, which is a benefit to see. Now, the problem when you look at this chart is it includes a loss of 35 million barrels. So as that starts to normalize, and as long as refiners continue to operate at the levels that they're operating, we expect to start to see some of these builds increase over the next few weeks. And this is just looking at Pad 3, just because Pad 3 is kind of that stopping point when we start looking at exports into the market. The slope has been in the right direction, and this is where we would see those Gulf of Mexico barrels really come out. And you can see it clearly showed up, and then obviously you had refining runs and you had exports that were fairly strong as we went through August, September, and then closed out fairly strong in October with, I think it was a little bit below estimates, but it was still about 3.2 million barrels a day on average, which is obviously a positive, getting some of this crude out there. But now as we go forward and we start to look at imports versus exports, and we're just covering imports here, Pad 2 continues to see a little bit of imports. Again, it's still below last year. It's still below the 5-year average, but it's really tracking pretty closely with where the typical flows are against the 5-year average. And then clearly Pad 3 continues to remain depressed. Just again, it's going to come down to refining runs. And we should start to see some of these imports pick back up as we start to grind a little bit higher as we go through the middle of November, and we start to see some of the refinery utilization rates start to track much closer to 80% instead of 75%. But that's something that's going to take a little bit of time overall. Pad 2 is the one to watch as we start to see additional Canadian barrels start to come down. And it'll be interesting to see where do they end up. Are they just going to stay in Pad 2? Are they going to continue down into Pad 3? Especially now that there's some specific new deals that have been signed from into the international market. So that's something that we're going to have to keep an eye on. And then Pad 5, as we talked about, it was going to ebb and flow. It was down again. Again, it's just mostly timing delays. So we should start to see a little bit of an increase over the next couple of weeks in Pad 5. But again, it's always going to be lumpy when we're starting to look at those import numbers. When we look at runs, it was up small, about 70 basis points, which closed out at about 75.3%, which was mostly Pad 3 as we had some refiners come down and then come back on because of the storm. And ahead of the storm, as some of the work was completed after Laura, some of the downtime starts to come back. But again, it's going to be at a very depressed, kind of that slow, steady state as we start to work our way back towards 80. It's not going to be a straight line. We could fall back, over the next week based on the numbers that we've seen. We expect to be up about another, let's call it 0.5% to 1%. But again, it's just going to be fairly consistent as we start to slowly grind back up, because we never got to the level that we thought we were going to get to, which is closer to 70. The lowest we got was about 72, and then we started to see some of that activity increase, specifically not only in Pad 3, but also in Pad 2. But it's, as you can see, it's still depressed versus year over year in the 5-year, which we'll talk about in a bit more detail. Implied demand remains lumpy. There's nothing surprising here. We talked about how we expected a walk back in gasoline, distillate. Propane is one that's going to remain the bright spot overall. We've been talking about NGLs and LPG as really kind of that bright spot when you look at total oil demand. Just because the liquids remains a stronger point. But the bigger issue is going to be in those first three when we look at gasoline, disti, and kerosene or jet fuel. And we continue to kind of track lower. Gasoline should see a little bit of an increase this week into next week, and we'll talk about that in a bit more detail. In the second part, but you can see again kind of the lumpiness within it. And now as we look at floating storage, we have a little bit more coming into our market. But again, it's going to remain at the low end of the spectrum. It should fall back within the bottom of the cloud, but again, it just because there's the spreads aren't really there. Libya is coming back to the market and now they're at 850,000 barrels a day. That's putting some additional pressure on European and Nigerian cargoes, which could be interesting when we start looking at how does that impact Iraq and some of the others, which we'll cover in a little bit more detail in segment 3. But this is one where we don't really see any meaningful move higher over the next few weeks. And because we don't see the same type of increase in VLCCs is the same reason why, as we've been saying, we're just going to stay within what we think the bottom end of the range when we start looking at imports, is because we just don't see too much new activity happening across the refiners in the Gulf of Mexico. Now, the one that we talked about was PADD 2. When we looked at imports, you can see that it's tracking pretty closely to the 5-year. Again, the trend is going to go up. We think it's going to continue to kind of close that gap to a certain extent because, again, obviously refiners aren't operating at the same rate. So, again, the imports won't be at the same rate. But you can see that it's still tracking pretty close to what we think is going to be the 5-year average as we go through the remainder of November. Now, we always talk about the refinery utilization rates, and it's important to look at where we were versus the historics. And you can see that we're going to continue to trend well below the average, but we should get to that bottom of the range, which is about 80%. Again, there is risk to that assumption, the risk being additional COVID cases, which we've seen throughout the Midwest, which has slowed down some demand. Obviously, new cases that have been forming within Europe, which has caused lockdowns. That's going to slow down some of the international demand that we normally see coming from our refined products, which is going to hinder some of this growth. But it's just important to appreciate some of where we were and where we have been, and that's why, again, as we look out, we think that we will get back to the high that was in October, but it's not going to be a straight line. It's going to be a little lumpy, and it'll be a similar trend up, but I think the slope is just going to be a little bit extended, and it's just that we have so much product not only floating in the market, but also when we start looking at some of our levels of storage, that there's a lot to work through in order to kind of get to that normalized component, which is something that we're going to talk about in more detail as we start going through some spreads and we start going through the intricacies within the different refined products as a whole.